track, the key takeaways from today's session that you can expect to learn. We'll look at a little bit of an introduction or an overview, if you will, at the funding process, of course, zooming in on from term sheet to the signed deal. We're going to deep dive in the specific terms. We're going to get very hands-on and technical in today's session. And also we'll talk about the intentions and the dynamics that come into play. Of course, we're going to talk about what that means about the VC journey so that you can use and apply these insights for your own startup. And Toge is going to talk a lot more about how you really run a thorough funding process. He's a great guy to ask some questions. He has been really structured and very strategic about the way that he ran his funding process. So there's a great deal to learn from Toge as well. And finally, we're going to talk about how you can use the term sheet on a strategic level, as well as level up your negotiation skills in the funding game. As always, we have the NPS survey coming up. Just really briefly, I'd love to hear your thoughts on today's session, as well as if you're struggling with anything, we can tap into future topics that can help you. Just feel free to include all the comments, and we'll definitely take it into concern when we develop the new program looking forward. So I think this is my part from now. I will give the mic to Jonathan, and final note that please just put in your questions in the Q&A, and we'll take them as it goes.
Okay, thank you, Camilla. I hope you can all see my screen now. Camilla is nodding, so I'm guessing it's working. Good morning. As Camilla said, my name is Jonathan, and I am the legal director and the attorney with the PreSeed Ventures, where I am responsible for the negotiation and executing of our investments, which obviously also includes the negotiation of our term sheets. I'm not going to bore you a lot about my background. I just want to say that I am educated from 3 tier 1 law firms in Copenhagen, after which I worked 2 years in a B2B SaaS startup called Legal Hero, before settling on the dark side of the force as a VC 1.5 years ago. So yeah, I think that's about it about me. So my agenda for today is something like this. First, I'll talk a bit about term sheets, what and why, meaning what is a term sheet and why do you want to get one or several. Then I am moving on to my list over the most important topics I believe you should discuss with your fellow founders before accepting a term sheet from a VC. And after that, I am finishing off with talking a bit about what the intentions behind a term sheet and a VC investment are, and obviously that's from a VC perspective. So yeah, that's going to be how I'll do it. Before I jump to the real part of my agenda, I have brought this slide about the fundraising process just to, even though you probably all know this, I made the slide to get us on the same page. So as you see, I have outlined the main steps of fundraising process. So the first part that you'd be doing is you'd be drafting and fine-tuning your pitch deck internally in the team, and then you will prepare how to run your funding process, which is basically identifying and lining up potential investors to talk to. When you've done that, you are obviously going to pitch the investors. The more the better. You should definitely try pitching as many as possible in order to get as good assets as you can. So that's something that you only get better by doing. So it's learning by doing, basically. So pitch as many as you can. And I know Toge is getting back on how to approach this and his tactics about this, so I'm not diving into this further. When you have had your pitching rounds and when you have had the chance to carry your flawless pitch deck around the town, pitching all the VCs and business angels, hopefully you will receive one or more term sheets, which is what we will be talking about today. So the term sheet is a document, like the first formal intention to invest from an investor perspective. And if a term sheet is agreed upon, then we as a VC will typically initiate our due diligence process, which in PreSeed, from PreSeed side, is a legal due diligence, a due diligence on a team, as well as a tech due diligence. So we are assessing your tech stack as well. And if all of these due diligences are carried out, showing the results that we want, and not disclosing any negative surprises, then we will be moving on to closing of the investment. So that's the typically fundraising process timeline. Today we'll be talking only about the term sheets, and that leads me to my first agenda point here: term sheets, what and why. So what is a term sheet and why do I need it as a founder? So basically, and you may all know this, but a term sheet is, so to speak, the document that contains all financial and legal main terms for the investment. I'm coming back to the legal terms. So the financial terms could be stuff like pre and post money valuation, whether the company, the startup, has any debt prior to the investment, and it could be terms about ownership and dilution. Obviously, you'd want a term sheet or several, as it means, as I said before, that someone intends to invest in your startup. And obviously you would want that when you start pitching. So that's the outcome you want. A term sheet from a legal perspective is a non-binding document, meaning it's not enforceable. And the term sheet is usually produced by the VC wanting to finance your startup. So that would be someone like us. When the investment round has multiple investors, which we often see, then the production of the term sheet is normally the responsibility of the lead investor, meaning the investor typically with the biggest ticket size. We normally syndicate with skilled and proven business angels or other VCs in order to de-risk our investment, and in order to secure you some strong and diverse hands-on help and skills in your board of directors after the conclusion of the investment. So once we or the parties involved reach an agreement on the details laid out in the term sheet, a binding agreement conforming to the terms of the term sheet will be drawn up by the lead investor. These documents in venture are usually an investment agreement and a shareholders agreement, and they are often referred to as long-form documents or just long forms. Before you get to that, and before you get to signing of a term sheet, I urge you to be mindful of the fact that you should use an unsigned term sheet strategically. I know Toge will be coming back to that, but in my opinion as well, you should, before signing a term sheet, you should use it as leverage for your round, meaning that you should take the term sheet and tell other VCs and angels that you have received the term sheet. If you do that, you will automatically be more interested to invest in, because someone has vetted you already. So my strongest recommendation to use a TS as leverage, and as I said, Toge will be coming back to that with more useful advice on that one. Obviously, you shouldn't sign a term sheet with a VC or a business angel syndicate if you do not expect to execute the deal. That's not how it works. It's a small ecosystem out there. So I mean, it is your good word and reputation on the line. So don't do that. The rumor will spread with the speed of light. And you should also be mindful of the fact that it is generally considered to be inappropriate to try negotiating on something already agreed upon in the term sheet afterwards. So if you are negotiating long forms and the term sheet states that you take on a lockup for 3 years, you shouldn't be negotiating on that. Do it on something else. So I mean, even though it isn't legally binding, it is like morally binding, so to speak, even though I don't like that expression as a lawyer. I hope this makes sense. Just to demystify, our term sheet in our tech fund looks like this. The front page and the first page. So you can see we are trying to do a rather lean and clean term sheet. And I'm not diving into the specifics here. I just wanted to show you how it looked like. So with this framework in order, I will be jumping down to what to look for in a term sheet from a founder perspective. And first of all, you should make sure you understand all the terms of the term sheet, obviously. And a good way to do that is to engage a lawyer with venture experience. Sometimes startups engage with lawyers who haven't been doing venture deals beforehand, and that's not speeding up the process or does anything good at all. So make sure you understand all the terms before you sign. I have outlined the six of what I believe are the key terms a VC would ask for. So we will require preemption rights, which are basically a right giving us as a shareholder the opportunity to buy additional shares in any future issue of a company's common stock. So that means that we could avoid dilution and retain our target ownership in your company. So that also means that you can expect a possible long journey with a VC you take in because a VC has the right to participate in future financing rounds. Another key term is the talk about ownership and warrant pool and allocation of warrants before or after the investment. So a lot of startups tend to talk about pre-money and post-money valuation, which is perfectly fine. We try to speak of ownership, fully diluted and non-diluted, to avoid confusion, meaning when we communicate the ownership we want for the investment amount, we communicate it as a fully diluted ownership, meaning that we calculate all warrants and outstanding options and unconverted convertibles. So our ownership, so we know what it will be when all of these instruments are converted in. I experience sometimes that in these talks about ownership, you sometimes talk about non-diluted or a pre-post money valuation, and then sometimes we don't quite connect with this. One party talking about a fully diluted ownership and another party talking about non-diluted. So you should be extremely mindful as to what type of ownership and what type of dilution the VC is communicating to you. Pretty much all VCs are locking you up, founder lockup provisions, because we invest in you as a team. So we are locking you up in your startup, meaning that for a period of typically 3, 4, 5 years, you are not allowed to sell your shares. So we want you to stay in the company and stay incentivized. So that's what a founder lockup term is about. we also require you to take on a key person clause. Most VCs does. So that's a clause where we ask you to take on a vesting scheme, which is timely parallel with the lockup period, meaning that key persons, typically the founders, are vesting your shares monthly over the agreed time period. And if you leave within the lockup period, then during the vesting period, then you are often obliged to sell back unvested shares at par value, and you can maybe keep vested shares on the assumption that you are a no-cost leaver or good leaver or whatever. And if you are a bad leaver, meaning you are in a breach of contract, then we can buy all of your shares at par value. So that's another provision that a VC will ask for, that is limiting your liberty and your freedom compared to before, and that you should be aware of as well, obviously. VCs also require tag-along, drag-along provisions, which tag-along is a provision that if you sell some of your shares, we can co-sell on similar terms. So we don't want all the founders to sell your shares in the company, leaving us back, because then the company is probably not much as worth as it were with you on board. And a drag-along is a provision that if the majority wants to sell, then the majority can force the minority to co-sell. So these are provisions that can actually make you want to do something that you maybe wouldn't want to do if we didn't have these provisions, like be forced to sell at a certain price. Also bear in mind that VCs require investor information, which meaning you are going to use some time on reporting going forward. So I think that's basically 5 minutes of what you should be extremely mindful of when you talk with the VC before you accept the term sheet. Understanding the intentions of a VC in 2 minutes. So negotiating a term sheet is typically our first encounter with you. So we actually want to get qualified pushback. We want you to challenge us where it makes sense. So pushback, ask us, why do you require such a substantial warrant pool? Why is the lockup period 3 years? And so on and so on. But do not mark up the term sheet, removing our preemption rights or stuff like that. Do it in a pushback in a manner where it makes sense. You should also bear in mind that how you negotiate your term sheet is a part of our assessment of you as founders. So how do you react when we refuse to change some terms, for instance? How do you react when a bullish lawyer like me tells you that this is a take it or leave it term? So we assess you as we negotiate. I think you should be really mindful too and understand the venture journey before jumping on board with the VC. So the VCs, we are not looking to exit your company for double our investment. We want you to keep growing your investment or your company for the next many years. And then hopefully we'd be IPOing your company on the New York Stock Exchange in 10 to 15 years at a unicorn level. So if you just want to build a proper business, which can be fine, and exit it for double what it's worth, it's fine, then you shouldn't engage with a VC. And obviously you should also bear in mind that a VC does not, we're not locking you up or asking you to take on founder vesting for the fun of it. It's basically a question of that we are investing in you as a team, and without you, our investment is basically nothing worth. So we want to secure our investment in you, harsh as it may be. So I think if you bear this in mind when you negotiate, it might loosen up the negotiations a bit. And my last slide is obviously this one. please feel free to hit us up with your pitch deck. We would love to take a look at your startup and get in a dialogue with you. So I'd be hanging out here for questions afterwards. So please feel free to spam me with whatever comes to mind.
Thank you, Jonathan, for the first presentation. I can see we also have a lot of questions, and don't worry, we'll bundle them up. But now Torge, live from Jutland, is going to take the stage.
Classic Torge. I remember I forgot to unmute my phone. Can you all hear me now? See my screen?
Yep.
Yes. Good. So my name is Torge, and I'm the CEO of a company called Interspeed. I will do a quick introduction of myself just briefly in a moment, but I want to split my presentation into two. The first thing is 5 minutes, 5-6 minutes about Interspeed, what we do, because that makes a lot of sense when I start to discuss a little bit about how did I approach the VC funding journey and towards the term sheet. So just a little quick introduction to Interspeed and to me, and then we can move on to the term sheet specifics. First of all, Interspeed, we are a company in the web development business. We want to secure faster, simpler, and better web development by democratizing high-performing APIs. Our small, mature startup is, we are 3 founders. We are all in the mid-30s to 40s. We have a various background with a lot of corporates, with a lot of building different solutions, and also with a lot of experience in what not to do. And that's actually part of the journey that we have embarked upon, is to say, okay, what kind of company do we want to build and who do we want to build it with? This is quite important going into the term sheet as well. One of the reasons why I chose to go with PreSeed Ventures was actually their network, and their network is what gave me my chairman, which I'm really, really glad to have. But that's Susanne. She has been in various roles in large companies and can help us quite significantly. So that's also part of some of the things that you should look for in a VC. How can they connect you with the rest of the world on the board membership, on the customer side, or anywhere on the investor side? Right now, we are owned by mainly the majority is owned by the founders, but we have PreSeed Ventures on board. We have Northeast Ventures on board. That's actually quite deliberate, but maybe I can come back to that later. And then we have some old, really early stage investors on board as well. We started in May 2020, just in the midst of the Corona when it started. So that's a difficult time to start a company. Don't do that. We are based in Aarhus. We are right now 8 employees, and we are offering a SaaS solution that is a high-performing SaaS product that is a layer between the front end and the back end. This is not quite important for today, so I don't want to jump into this. We have a lot of great customers, and actually we are missing a couple of really nice logos, but that will be coming in the coming weeks. Just a little bit about my company. We have tried on our own body that there's a misalignment in the C-suite. Actually, if you look at a large companies, the CEO, he just wants digital transformation, and he wants to be, how can we compete better? Then the marketing officer says, I want revenue and I want good customer experiences, and I want it fast. And the CIO say, oh, I want stability and compliance. And by the way, I'm overwhelmed with security, risk, I need people, and I have a lot of technical debt. And the CFOs are sitting in the corner and say, I want a good investment profile, and then I don't want any impairment of the things that we have done in the past. So there's a huge misalignment on what does digital transformation mean. The only way to solve that is by decoupling your infrastructure and enable all the different systems to be connected by high-performing APIs. That's why we are in the business. Because everybody talks headless, composable, decoupled infrastructure, but in reality, agility demands better and faster access to data, and that's what we deliver. We have done some really high progression on how to simplify, how we can consolidate data. We have solved a couple of pains around how to ingest data simply. We have done a lot of work, And then we have done a lot of work on helping you getting it blazing fast out of the data accelerator that we have built. This gives a lot of benefits, and I can talk for hours about what to do. And that's mainly because I've been sitting in this rabbit hole for many months. I don't want to do that with you guys, but just to say, trust me, there's a lot of benefits for doing this kind of journey. And by the way, there is a big need for it. So if you look at the web development market, there is a huge amount of scarcity in developers and those who operate IT solutions. There's a lot of need for speed, because the faster website loads, the more revenue you get. There's also a need for changing the customer experiences rapidly. There's also a high demand on secure solutions. And there is also a demand for actually making some of the complex infrastructures more simple. And that's where we do see that we have a play in mind. But if we talk a play like this, we need to go big. And that was actually starting on our side of the VC journey. We needed investors that could really boost our investments into people, into customers, and into markets. And it's not by investing in, oh, here's a small piece, go back and in 2 months' time, let me see how far you got. We needed big money to go far. And that means that we needed somebody who understands how to make a rocket, so to say, but actually make explosive growth. And we needed help for that. And that's the reason why we chose the VC way. And that's where we say where we are in our funding journey. We are in the middle of pre-seed and seed. We are right now check marking our proof of concepts. We have got a lot of good customers and clients and partners. And now we need clever money to make us scale. So in a couple of months, we are gonna dip into the market again and look for money to make growth expansions towards more markets in the coming years. So actually, that's just to point where we are. So I've been through the first round of VC investment, and that's my standing point for this discussion today. And I'm gonna enter a new one just shortly, and I will use some of the same tricks for that dialogue. First of all, to me, there was 5 key elements that was important to me. First of all, I'm an old Boy Scout, and the motto from the old Boy Scouts was "Be prepared," and that's a key term here. Know exactly who you're looking for. Know who is your favorites. Know who you don't want to invest in your company, but you actually would like their feedback. Know what to say and when to say it at the right times. That's really important. So the preparation will be really key to this. Then secondly, as Jonathan also said, they are evaluating from the first time you're entering the door. You should do the same. You should do your efforts to know them, to test them, do your due diligence on the people that you're negotiating with. Understand them and know them, what they look like, and how they act on certain things. Then spend a lot of time to understand the conditions. Not only in, okay, what is the legal written stuff that is in the contract, but actually understand what does it actually mean and why have you put in that paragraph. Because it's first when you start to understand the why, you understand, okay, it's not that tough as it appears in written. Then fourth, be sure that you know exactly what are the worst case scenarios. What will happen to you, your family, your co-founders, your employees in the case of worst case scenarios. Because it's first when you start to understand that you can say, okay, then I have everything to win and I know exactly what to lose. And that was at least my approach into it, is to understand what is the worst case scenario based on the term sheets that is in front of you. And then, as Jonathan also talked about a couple of times, understand your negotiation power. understand where you can play the game and where you shouldn't play the game, and understand what is your leverage in the market and towards the VC that is in front of you. So first and key takeaway is be clear on what is truly important to you. So if it's important to you and your company that you get an VC that has a lot of money, but not a lot of knowledge, and you only need the money, then fine, go with that. But if you need both, then the amount of investors that you should be looking for is narrowed significantly down. So that's actually really key to this process. Be clear on what's important to you. If I try to double click on some of those things, in the preparation phase, I spent quite some time to understand who is my favorite and why. So I talked to a lot of VCs in the first round, and I had a clear favorite that was PreSeed Ventures, and I'm lucky to stay here and say that I got my favorite. And there was a couple of reasons for that. First of all, they were pretty strong in the tech space. I knew some of the people in the VC, and I knew that they are behaving good, and they are quite easy to get around with, and also understand me as a person and my business. That was quite important. So understanding who's your favorite, and try to rank them as well, because what I did was I was pitching in pools of 10, meaning that I took 10 VCs. I took the whole preparation, and then I talked to 10 different ones, and PSV was my number 5, and that was very deliberate, because I wanted to test out all the different things that I was singing and dancing, and how the different moves worked, and then I was ready to play my final at the 5th game. And if that didn't work, then I at least had 4 other shots in afterwards. Then secondly, do understand where you gain match fitness. So I'm coming out of a sports world, but you cannot play the Champions League final just on. You need to test it out several times, and that was why I pulled it in 10 and say the first 5 they were training, and it was okay if they got some if they gave me some term sheets and so on, but the real prize was after number 5 and afterwards. So actually just understand where do you practice enough to be really good at your pitch when the shit hits the fan, and then understand exactly what you're playing for. And that's quite easy to say and difficult to do, but be sure on what are you actually playing for. Be specific around the amount of money you want. Be specific around some of the key terms that you want, and also be specific around what kind of investors and those board members that you want on board, because that goes without saying. You're gonna get some of those, but be clear on what you're going to get, because that's also going to help you evaluate between the term sheets. And if you get more than one term sheet, you are actually starting to be able to evaluate quite significantly. And then I simply just love the quote that I got from my old statistic teacher at the university, saying an exam is a party for the well prepared, and that is basically the same for pitching to investors. Okay, one thing that I learned is that people trade with people, and you also heard Jonathan saying that they are actually investing in people more than they're investing in companies. They are investing in people and with really good ideas and a team that can actually execute on that idea. You should do the same. You should understand who are they. I call quite a lot around to know who are the people that I'm dealing with at the PreSeed Ventures. I knew one of them from back when I was a kid, so that helped quite a lot. But actually, this is hugely important to do your own due diligence of the people that you're meeting on the other side. Don't do business with strangers in that regards, because you need a close collaboration with those guys in the long run. Then do they do what they say? If they promise you to give you something on Monday, do they actually deliver on that on Monday? Or do they promise to take out a certain phrase and they don't do it? that's also some of the things that I was looking for, because that tells quite a lot about the VC that you are up against. I'm not saying that VCs are shady. I'm just saying I want to trade with people that deliver what they promise, because that's what you need when everything else is starting to go really fast. And then one of the things that, and we can probably come back to my own process, but how are they reacting on curveballs? We had a lot of issues on my transaction because I was a part of a spin-off from another company, and we needed to do that spin-off quite fast and without any major obstacles. But there were some curveballs. And the good side of my process was actually to learn how did PreSeed Ventures actually deal with the curveballs. Were they finding solutions, or were they just no? Because that's a first step in how are they going to react when a curveball comes to my company when we are playing together. So people trade with people. Be sure you want to trade with them, and that's a really important lesson that I've at least been learning the last year, and I'm really pleased to say that I'm dealing with PreSeed Ventures. Understand the conditions. So, and this sounds maybe a little bit superficial or dumb of me to say, but I was less. I didn't care as much as you would think about the actual amount that was in the term sheet. I was more around, is it in the right ballpark? Was the conditions the right conditions? And was the intentions behind the conditions, were those the right ones? And this is just to say that you can get a lot of term sheets with really high numbers, but then there are some conditions and intentions behind those really high numbers that you don't want, and they are also worth quite a lot. So it's the package that you need to evaluate. You need to understand the conditions of the lockup, of the drag along, tag along, and how is the conditions there, but also the intentions. We had some long dialogues with Jonathan back in the days where there was some legal stuff that was really hard for me to understand, and I asked, why do you need this? And then we got 10 good examples, and from that we can say, okay, I understand the intentions. Why are you not writing that in the contract? And then we were actually getting closer to what it was. I didn't give up anything, but I actually started to understood why the intention was in there. So understand all the aspects, I cannot talk today, all the aspects beyond the money, then start to negotiate, because that's where you have the full package to negotiate from. Then one thing that was extremely important to me was to understand the worst case scenario. What happens to you if worst case scenario emerge? Are you gonna leave your home? Are your wife gonna be extremely mad at you? That's goes without saying. But at least some of the other things that you need to understand, what happens to a company, what happens to the rights that you have built over the last couple of years and so on. So that was truly important to understand, and I think everybody should actually have that worst case scenario. What happens? How many money should I come with if the shit hits the fan? Secondly, how do they act in difficult times? I wouldn't say lucky, because that was really stressful, but we had some curveballs, as I mentioned earlier, and how PreSeed Ventures reacted on those curveballs, that was really positive, because times will become difficult. And I know that because sometimes you are not meeting the budgets, or sometimes the customers are not paying as much as you would like, and so on. But the important thing, how are the VCs acting when it becomes difficult? Are they supporting you? Are they throwing everything at their hands, trying to help you? That is at least the feeling that I got, is that they would really want to help me. Or are they just saying, you're on your own, we cut the strings, and then good luck on that? So that was actually quite important to me. And then finally, what is the plan for recovery? Understand if there is a plan, understand what to do if you need to do a recovery plan one way or the other. That's also quite important to have that in and maybe you won't ever need it, but at least I'm feeling really assured that I have one in the back if that's needed. Then final thing, I can only say that you need a lot of dialogues. You, as a founder, you are running a illiquid asset. And in order to price an asset like that, you need a lot of dialogues, you need a lot of buying signals before you can actually set the right price on your company. So I encourage everybody to just at least have more than 5 dialogues around, can you and will they actually want to invest in your company? Because that's where you can get a better sense of your valuation. Then understand working with FOMO. I didn't really understand it in the first place, but when I started to have a term sheet in my hand, it became quite clear. It's easier to go back and say, do you know what? I need a meeting now because I have another term sheet, and you got the meeting immediately. So don't sign the term sheet until you're sure that you have seen all the term sheets that you want to see, and then try to use that. Don't say what's in the term sheet, because you also need the confidentiality and you want to play the game a little bit. But at least you can say that I now have a term sheet. Be honest about it, and then also one thing that is really important to me is that remember that you need to work with the VCs afterwards. So don't overplay your cards. Don't lie or anything else. Be straight. Be honest. Play the game. Everybody knows it's fair game, but don't overplay it. I wouldn't work with anyone who has overplayed their cards towards me, and I figure it out afterwards. So that's also my mantra into this, and I probably know that the PreSeed Ventures at least would say the same, that they don't want to work with anyone who has been shady in their communication in the negotiation and term sheet process. I think that was it for me.
Thank you, Toge. So we have, if you can just unshare your screen, that would be perfect.
Yes.
Thank you. Okay, so we have a lot of different questions, so I think we're just going to dive straight to it. I'm going to take the ones that have been upvoted by most so that we can help as many as possible. So, should a startup ever accept to work with an investor that submits term sheets with an expiry date, since that puts pressure on a small team that may be resource constrained on its ability to raise? Jonathan, would you take this one?
Sure. No, I mean, I think you should only work with investors who understand where you're coming from. I mean, when we finance someone, the urgency is typically mostly because the startup is about to run out of money. So I mean, I think we should all both sides take the time that we need to do this properly and in a way that everybody feels that the process has been a good one, because when we first conclude an agreement, we will be working with each other for quite some time afterwards. So, I mean, from my perspective, no stress. And I think if someone requires you to or pushes you to sign anything within a deadline, I think it says something about how they work. So that'd be my take on that.
Also,
I agree.
Do you have any comments, Toge? Sorry.
No, yeah, but it's just I agree pretty much, because then if they are pressing you on this on a very short deadline, then what will they do afterwards? It tells a lot about them in your due diligence as well.
That's a good point. So what happens if the deal falls through after signing or after having handed out a term sheet? Maybe take that one as well. It's a short one.
Yeah, what happens? Yeah, I mean, sometimes after the signing of a term sheet, we, as I said, we do our due diligence on legal stuff and on the team and on the tech stack. So obviously, deal breakers would be that we discover something that we do not like, and an example could be that our legal due diligence shows us that all of your shares has been sold to someone else, or that you have been conducting some tax fraud or something. So I mean, we see what you present us to, and if there's something really I mean severe, then we might back off. It's really rarely that the team due diligence makes us walk away from a deal, and the tech due diligence, maybe if you have been overselling the quality of your tech stack by a great deal, then we might be considering to walk away, or to renegotiate the pricing or the valuation or the ownership or whatever. So that be something like that.
Okay, maybe you can both answer the next one. If you love the lead investor, but he wants to bring on some other VC that you don't know, should you accept or refuse, negotiate, how to go about that? Maybe you will start, Jonathan, and then Toge will also tell a little bit about his own.
Yeah, my take on that is that in my opinion, it's the founders who determines his or her round. So I mean, it's the founders who are going to work with the VCs going forward in the company on a strategic level. So I believe it should be the founders who decide how the syndication is composed. And I believe that most lead investors, they understand that. And if they don't, then you should reconsider if they are the right lead investor.
Yeah, I can only echo that. It's your company. You need to understand what is best for your company. The co-investor might be really good, but then you need to learn him before you say yes. Mm-hmm. Don't do anything that you don't know anything about. So I'm more to the thing that you should be in control of this process. Mm-hmm. And you are saying yes and no. You might be forced into saying yes to something that you don't like. Because you need the money, but try at least as much as you can to say yes to things that you want to say yes to, as much as possible.
That's a good point. Thank you, Toge. Okay, let's take this one. It's also pretty popular. Would most VC assume maximum fulfillment of the entire staff pool, all convertibles and so forth, or is that being negotiated sometimes?
Good question. So obviously when we is doing our investment, we will ask you basically, we will get your, if you have issued convertibles already, we will review them and assess whether they are triggered by our investment, and we will ask you to provide us with a cap table where you include all your convertibles and your warrant pool, and whether or I mean to what extent the warrant pool has been used. And then on back of that, we will sit down with you and assess how big a warrant pool we need to attract the people you need in your startup going forward in order to fuel the rocket in the way that you have presented to us. So yeah, I think we are assuming that when we are talking fully diluted ownership, we are assuming a fully as converted basis of all instruments, including warrant pool, option pools, and convertibles. I hope that was loud and clear enough.
Okay, so maybe Toge, you can take the lead on the next question. It's a little bit about the negotiation process. It says, regarding negotiation terms of term sheet, is it considered a bad practice to negotiate the terms the investor has put on the term sheet? When and what should negotiation then rather take place? And also, how does one do best continue the negotiation in the potential scenarios that another investors offer improved terms after the initial investor has offered the term sheet? Toge, will you maybe take the lead a little bit on how you sort of took on the negotiation?
I think it's important to understand that once you have signed the term sheet, at least the money value is out of scope then. So there is some of the things that is, when you have signed the term sheet, there's some of the things that you put automatically out of scope. So you need to understand that because afterwards there is another contract negotiation that called the long forms that Jonathan was also talking about. What I did was I had another term sheet and this one and say, okay, how can I match them? And coming back and say, before I sign it, I actually have something that is in this regard. So when we talk term sheets, you discuss what's in the term sheet. But once you have signed the term sheet, those are signed. I think Jonathan will say as well that it's bad practice to come back and say, oh, now I need more money after the term sheet is signed. So we need to understand that the deal is structured in different phases. And once you have said yes to one phase, they are closed. You have agreed on that, and then you move on to the next thing. I think that's quite important to understand in that process. And so I think it varies from people to people how they want to negotiate exactly on the term sheets and how they want to leverage the negotiation power. But I think the most important thing here is to see it in phases and see once you have locked in on the number, don't go back on that one.
Okay, also let's jump to this one. Having a non-signed term sheet can be used to create momentum and negotiation power, as we talked about. What about confidentiality with the investors? Maybe Jonathan, you will take the lead.
Yeah, sure. So the confidentiality clause in a term sheet is obviously only applying after you've signed it. So that's why I wanted to use an unsigned term sheet for leverage. So, and I mean, you shouldn't be sending whatever term sheet you've been getting. You shouldn't be sending it out to others. You can just communicate the terms, and you can tell that you have a term sheet. So that's how I want you to use it, and that's perfectly fine. So there is no confidentiality before you have signed it, and that's the name of the game. But don't broadcast it to everyone. That's not a recommendation.
I was just to add on that one. I didn't disclose any of the term sheets. I said I was talking to others, and I could prove it if they want to get the proof. So I was talking the truth, but I was not saying what the other terms were and how they were structured. But I was just saying I'm in dialogue with others. That is this, and they can, and I got a term sheet. So based on that, then the VC must do their best if they want to continue with me.
Thank you. Okay, so we have short on time, but I'll make sure that we sign up for all the answers going up in the outgoing email. But let's just take the last quick one, I hope. Jonathan, is a previous vesting documents overruled by a new vesting agreement on an investment term sheet? Maybe take that as the last one we do live.
Yeah, so when you sign a term sheet and we negotiate a new shareholders agreement, then it would normally like the vesting will be like it will be restarted from closing. So every time you take in VC money, you will start on a new vesting scheme. So that means if you want to embark on the venture journey, you will probably be locked up and vesting from now on and until you exit. So you should keep that in mind. I always say to the companies that I negotiate with that the documents are only meant to survive until the next funding round, meaning that we shouldn't be discussing a lockup of 3 or 4 or 5 years, because if you were getting new funding in 2 years, then you will automatically be put on a new vesting, a new lockup period. So yes, will be reset.
Thank you, Jonathan, and thank you, Toge. We've run out of time, but as I said, you'll get an outgoing email, and I'll make sure that we take all the last questions so everything is covered. But finally, thank you everyone for joining. Thank you, Toge from Jutland. Thank you, Jonathan, and have a nice day, everyone.
You too.
Cheers.
Thank you.
Bye.
Cheers.